All right, welcome everyone to Apt Wealth Partners regular event series. Today we're talking about a topic we love, retirement. Stop thinking and start planning. Welcome to friends and family of Apt Wealth. Any existing clients on the call today, welcome. You'll likely have heard this before as part of our recurring webinar series, but you're most welcome to listen again. I'm Andrew Dunbar, CEO of Apt Wealth Partners, and I've been helping people live and plan their best retirement for over 20 years. So I really look forward to this webinar each time, trying to share what I've learned over that journey with you. Just some quick housekeeping to begin. You'll see the Q&A box in your Zoom menu there. We should have some time for questions at the end. So as we go through the presentation today, if you've got any questions, just pop them into the Q&A box and I'll get to as many of those as we can. We will send out a recording of today's event afterwards. And during the event today, I'm going to run a few polls. Now, they're totally anonymous. No one else can see your response, but it does help me just to get some feedback from the room and tailor the presentation as we go along. So I encourage you to participate in those if you can. All right, quick disclaimer. The information today is general in nature. It doesn't take into account your personal circumstances, and you should always seek personal advice. Okay, so retirement. We're here to talk about retirement, and this is a topic that we love to talk about at Apt Wealth. We love planning for it. We love living through it with our clients, and we've helped thousands of families through this journey. Lots of stories over that time. We've seen a lot of mistakes made, and ultimately a lot of successes as well along the way. So hopefully we can share that with you today. So I looked up the dictionary, a bit old school, looked up the dictionary for the meaning of the word retirement. And this is what the dictionary said: the act of leaving your job and stopping work, usually because you are old. Wow. So I don't know about you, but I think we've got to challenge that definition. That is not what modern retirement is about. And the current statistics right now say that a 65-year-old couple have a 50% chance of one of them living into their late 90s. So we might not be doing jumping jacks and flying around the world and so at that age, but we could be doing that in our 80s. And that's a lot of life to live, and especially with medical technology as well and the way that's heading. We've got to think about this as really a large phase of our life that we want to live with purpose and get the most out of. So this is our favorite quote at Apt Wealth, which is, at your end, you'll regret the things you didn't do instead of the things that you did. And retirement is a time that everyone looks forward to. They dream about it and think it's going to be all wonderful. But we've got to reimagine retirement a little bit today, because life used to be pretty simple. We would grow up, we'd study, we'd then go to work for 40 years and then we'd retire. But now life is a bit different. We study, we work, then we might go back and study. People might have a career break, go back to work, study again, do some part-time work later on in life while still living life to the full. And there's a lot of life to live in that last phase where, historically maybe lifespans we weren't expecting to live that long after retirement. So it really is a time for new beginnings, new successes, new experiences, and really building and creating your legacy. And preparation is the key to all of that. Being mentally and financially prepared is what gives you the freedom to do it. Now, unfortunately, it's not a time that's well planned for. And this means most people don't end up living that ultimate retirement lifestyle that they'd been dreaming about their whole life, when really there was no reason that they shouldn't have. So with that in mind, let's have a look at the agenda for today. We're going to work through a few topics here. We'll have a look at how much you need to retire. What does retirement look like specifically to you? Talk about investments. We'll talk about superannuation. Have a look at some estate planning. And then I want to leave some time to talk about not just the financial transition into retirement, but also the lifestyle and emotional transition to retirement. So this is a stat that I find quite staggering, which is 1 in 5 Australians think about retirement daily or often. And whilst it's staggering at first, I get it because we see this all the time, and there is a lot of change. There's a lot to think about heading into retirement, and things to worry about. So all of these things here around, will my money last? The pension. What is my lifestyle going to look like? Am I going to run out of money? These are all short, valid concerns that people have heading into this phase of life. It's perfectly normal. And what happens, most of us go through life worrying about these things. We just make some decisions along the way. They're educated guesses, I suppose, and hoping that things will work out. But hope is not a strategy. It's only with proper planning that we can really alleviate that anxiety. And there's been some really interesting recent studies that back this up on people checking their superannuation balance. Now, those working who are accumulating superannuation through their working life, they maybe check their balance once a quarter or even once a year when they get their statement on email or in the mail. But those who are retired, they're often checking their balance once a day or even multiple times per day. Now, why on earth would you check your superannuation balance multiple times per day? And I think it comes back to this worry we're talking about. People not properly planning, not understanding how they're structured, and having the peace of mind that the daily, weekly, monthly moves in your balance, they have no impact, should have no impact on how you're living your lifestyle and thinking about retirement. But because people haven't planned for that, they worry about it. So really interesting. Now, I wanted to run a bit of a poll in the room on how much you think the average couple would need to retire. Is it 300,000, 500,000, 750,000, a million or more? So I'm just going to put this poll up on the screen. Really appreciate if we could get some responses to this and just see what everyone thinks. So just run that poll. We'll give it a few seconds for people to put their responses in, and then I'll share that with you all. Okay, so I'll end that poll. I will share the results here on screen. So you can see actually we've got a wide variation of responses, which is great. A lot in the more than a million category. Predominantly, most people are saying over 750,000, over $1 million. So thanks very much for sharing that. And that is really interesting because almost on every occasion, people overestimate the amount that they need to live a comfortable retirement. Now, the Association of Superannuation Funds and the Australian Bureau of Statistics, they do a study every year on this using all the latest spending data on what it costs someone to live a comfortable retirement. And at the moment, on the latest figures, for a single person, they say retiring with 630,000 is enough. For a couple, 730,000. And that comfortable retirement is a good lifestyle with a good car, clothes, electronic equipment, eating out, domestic travel, and then occasional overseas travel. So 730,000, maybe 30 years of retirement or healthy living. Um, is that comfortable for you? And really, I suppose the answer is that it depends. And it depends on what sort of lifestyle you individually want to live during retirement and how much you're going to need to spend each year. There is not a one size fits all answer to that question. And that's why we saw in that poll, a range of different answers. So some of the things to consider, will you completely stop work or do you plan on continuing bringing in some income through part-time work or other means? Are you planning to stay in the family home or are you thinking about downsizing? What does cars look like to you? Do you want one car, two cars? Do you want to drive a luxury Mercedes or a Toyota Corolla? What does travel look like for you? Do you want to travel around Australia in your caravan? Do you want to take the odd cruise or do you want to fly around the world in business class every year? And then, of course, we've got the kippers, which is kids in parents' pockets eroding retirement savings. So, what does that look like as a family to you? Are you helping with education for grandkids? Are you helping kids out with first homes, things like that? So, the answers to all of these questions are going to ultimately determine what amount of money you need to fund that lifestyle that you'd like to live. And that is really the first question that we run through with clients to try and identify that. These are those figures that we were just talking about. Where a comfortable lifestyle currently, the Bureau of Statistics and Association of Super Funds say 77,000 for a couple, roughly 55,000 for a single person, and a very modest basic lifestyle without those additional luxuries, 51,000 for a couple and 35,000 a year for a single person, which coincidentally is around about the amount of the age pension for someone who's getting the full age pension. So your number will be different to that depending on your own individual objectives. But no matter what that number is, this is always very consistent. We see two types of retirees. These are in the clients that are coming in to see us, meet with us every day. So this is represented by the blue and by the red on this chart here. So you retire with a certain amount of money. That money will be invested, whether it's in superannuation or other means, and it will fluctuate over time. It will go up and down year to year, but every year it will produce some income. Now, the first type of person represented by the blue, they're generating some income, and that income is enough for them to do all the things that they want to do. And when that person comes in to see us, they are very relaxed and happy. The conversations go like, oh, let us tell you about our latest overseas trip. Here's what our kids and grandkids are doing. We'd like to help out these not for profit organizations. You can tell they are at ease with their money. They're not losing any sleep at night, just getting on with their lifestyle and enjoying themselves. That was their whole objective for retirement. Now, the second type of client represented by the red here is a little bit different in that they start with an amount of money, could be more, could be less than the first type of person, but they need to spend more than what the income that's being generated to achieve all of their lifestyle objectives. And so each year they are actually drawing down some of their capital as well over time to fund all of those things. Now, that's actually okay. That's how the whole superannuation system was designed, where we were supposed to work for our lives, build it up, and then spend it down over our retirement years. But the mindset is very different for people. When you see these people, the conversation's much more like, oh, do you think that we could afford to take a trip next year? Do you think we could afford to help our kids out? What's happening with this investment? You can tell that money's playing much more on their mind. It's causing them stress, and they just can't get on and enjoy themselves. So, whilst we'd ideally like to position everyone in that type 1 category, that's not always the case. And really, planning is the key, no matter which situation, to ensuring that you approach your retirement with that attitude of, yes, we're comfortable, we know the trajectory that we're on, and we can get on and do the things that we want to do. So when we're working with clients, we have a checklist of objectives that we work through financially, of course. So yes, we want to maximize superannuation. We want to make sure that we are minimizing tax, accessing any government benefits that we could get. and we want to set up our investments so that we're protected no matter what happens in the markets. So all of that, yes, it's very important. However, what we're really trying to do is to give people peace of mind that they can live that lifestyle that they want. And that's the whole objective in retirement planning, no matter what your number is that you need to retire with and need to spend each year. And if you've got your health, well, I think those two things really then just set you up to live the life that you want to live. So once you know your number, then the question is, where are you going to get this money from? And there's different avenues. Some will rely part or all on the age pension from the government. Some will have money in superannuation that they've built up. Some people will have some savings, and some will have investments. So I want to talk about some of these, and starting with investments, because this is a critical part of retirement and having that peace of mind in retirement. So I've put a chart up here, and the first thing that I can promise you is that there will be downturns during your retirement years. I don't know when, but I can promise you it will happen. And we are now, over 15 years since the global financial crisis. So, it's not unreasonable to expect that something like that could happen again, but of course, no one knows when. And what this chart shows us is the grey bars show the annual return on the share market. From the 1st of January to the 31st of December, what was the return for that total time period? And you can see in most years, it's a solid positive number. There's the odd year where it produces a negative. However, no matter what that total return is, during the year, you can see there's these red dots, and the red dots represent the biggest downturn at any point during the year. And you can see that that occurs every year. So if you take 2012, 2013 as two that are very similar, you can see the annual return was 15% from start to finish in both of those years. However, in both years, there was a downturn. 2012, the market fell 10% at one point. In 2013, the market fell 11% at one point. So this is just a normal part of investing. And what we've got to do is set you up so that you can survive these downturns and it doesn't impact on your longer term lifestyle objectives. So how do you do that? Well, there's really a fundamental principle that we've learned over our time dealing with retirees and investment portfolios. And what we're looking at here is two different styles of portfolio. In the middle is the standard type of employer fund, balance fund, growth fund. This is in many employer super schemes. And what happens here is the money's invested across some Australian shares, international shares, property, fixed interest, cash. And there's thousands of investors in that same fund, and each investor just owns a number of units in the fund. So, for example, you might have 1 million units. Each unit was worth $1, and that's your $1 million that you have in super. And over time, the investments will move up and down in value and also earn some income. And it's that movement in the unit price as a result of those investment movements that will impact the dollar value that you have in the fund. The second portfolio around the outside is the same, but where you hold these investments directly yourself. You've got some Australian shares, international shares, property, fixed interest, cash, exactly the same, but you know exactly what you own, number one, and that in itself is comforting. If I own Commonwealth Bank and it drops by 10%, its share price drops by 10%, well, I know it's Commonwealth Bank. I know it's still going to be here in 5 years' time, in 10 years' time, and making a profit for me, and I'm comfortable with those shares. So it adds to peace of mind. But more importantly is the impact of this when there's a downturn, which, as we just looked at, we know is going to happen every year. And I want to run through a case study here just to highlight how that works. So we've got Max and Jane here. And this is a global financial crisis Mark II scenario where the share market drops by half, and then it takes 5 years to recover back to that original value. So this would be a pretty dire straight situation. Now, Max has got that portfolio we talked about first, unitized fund. And what's happening every month to get his $6,000 that he needs to spend. By the way, Jane and Max both spend the same amount of money per year, $72,000 or $6,000 a month. So for Max to get his $6,000 a month, he needs to sell 6,000 units in his fund if each unit was worth $1 to get his $6,000. And so what he's hoping is that that unit price goes up over time so that even though he's selling more units over time, his overall value stays the same because each unit's worth more. But in this case, when the unit price drops by 50% and the unit price is 50 cents now, well, he's now needing to sell 12,000 units every month to get his $6,000. And so the share market will recover, but by the time it does, he's sold down so many units in his fund that he just won't ever recover his money. Now, we contrast that with Jane, who has almost exactly the same investments, but she just holds each of her investments directly. Now, all of the dividends and interest that she earns on those investments are going into a separate cash account, and it's only from that cash that Jane draws her $6,000 a month. So she's not touching any of her investments. She can leave them intact, wait for them to go down in value, go back up in value, and recover. And so by the time the market recovers and just gets back to that point that it was originally, Jane is over $463,000 better off just because of that simple structuring. And this is an example that we see time and time again, and what allows people to live comfortably through their retirement despite market challenges happening each and every year. Okay, so moving on to superannuation. And superannuation really is one of the last free lunches in Australia, and it forms such an important part of retirement planning, and even more so with the recent budget changes that the federal government announced around trusts, capital gains tax, and so forth. Superannuation is even more attractive than ever. So let's have a look at that. Now, why is superannuation such a good place for our investments? One, it reduces our personal tax. While we're working and contributing, we pay less tax by putting money into superannuation. We'll have a look at that. The earnings are very tax effective, okay, and we'll have a look at that as well. It's forced savings for retirement, and I often speak to 30 and 40-year-olds and they say, well, why should I put money in superannuation? You know, I can't access it for so long, that's tomorrow's problem. But that is the wrong attitude. Knowing that superannuation is on track to provide you a comfortable retirement is actually the enabler of having a lifestyle today. You can spend freely and confidently knowing that your retirement is looked after. So I have a different view of that. It's a very effective estate planning tool. We'll talk about that as well. And of course, in retirement, it produces tax-free income. It's fantastic. All right. So how do we get money into superannuation? Well, there's two primary forms. One is called a concessional contribution. One is called a non-concessional contribution. Now, concessional contribution is that the employer puts in for you, or you salary sacrifice, or you're putting in and claiming a tax deduction for. And there's a limit per year of how much we can put in of $30,000 per year. Non-concessional is money in our bank account or from the sale of an asset or something that we've got and we just want to put into superannuation with no tax consequence. And that has a separate limit of $120,000 per year. Now, you can also do 3 years in one, non-concessional. So you could put $360,000 in one hit, and that would mean you couldn't then contribute for the next 2 years when it would reset. So that's how we get money in. Now, the benefit of a concessional contribution on our current tax rates, when we put the money into superannuation, it's taxed at 15%. You can see the different tax rates here. So if someone was earning $150,000, for example, their income tax rate would be 39 cents in the dollar. But by putting that money into superannuation instead, they're only paying 15% tax. So they're saving 24 cents in the dollar on that contribution. So it's quite powerful. Now, for higher income earners above 250,000, they do apply additional tax, and it means you have to pay 30%, not 15%, but there's still a significant advantage. Then the earnings within superannuation. There's two phases of superannuation. One is the accumulation phase, where you're contributing and building the balance up. In that phase, every dollar that the fund earns is taxed at 15%. Okay, so that's still much less than if it was in our own name and we were paying our own marginal tax rates on it. So it's very attractive. The real power comes then in retirement, and we switch over to what's called pension phase, which is where we start drawing down on our superannuation. And at that point, the earnings of the fund are tax-free. Okay, so it's very powerful to have the majority of your investments within superannuation. Now, as a compensation for tax-free earnings, the government forces us to take a minimum amount out of the pension each year, and that amount goes up as we get older, as you can see there on the right-hand side. And that stops people just building up endless amounts in a tax-free environment in super, and hopefully spending some of that money in the economy. Now, the most recent legislation that's passed relating to superannuation is the Division 296 tax. I'm not going to go into detail on that today. If you do want detail, jump on our YouTube page. We did a recent full webinar on Division 296 tax and explained all the intricacies. But at a high level, this was otherwise known as the $3 million superannuation cap. And what it does is apply an additional 15% tax or the proportion of the balance above 3 million, and then another 10% on top of that if your balance is above 10 million. So at the moment, we just talked about the fact that in accumulation, if your balance is under $3 million accumulation, you pay 15% tax. On pension phase, there's 0% tax. That doesn't change going forward for under $3 million. The only thing that changes is the proportion of the balance above 3 million, where there'll be 15% additional tax on the proportion of earnings that are over $3 million. So if your balance was $4 million, 75% of that is under. Only 25% of the earnings would attract that additional 15% tax. And of course, the extra 10% for above 10 million as well. The way the tax is calculated is taking the balance, total superannuation balance. So it doesn't matter whether it's in a pension or in superannuation, total superannuation balance at the end of the year, subtracting the balance at the start of the year, and they'll work out what the proportion of earnings are above the $3 million and apply the additional tax to that. Now, the first real relevant date is the 30th of June 2027. So we don't need to panic just yet. But if your balance is at that amount, approaching that amount or above, then I suggest you engage with your advisor and start planning ahead for that. So just talking about maximising superannuation, which still, up to $3 million as an individual, 100% we should be doing that, potentially even above that balance. That can be worked through with your advisor. This is this is an unknown, or largely unknown rule, which is very powerful to get some money into superannuation, particularly later in life, and that is the catch-up concessional contribution rule. And this is where any unused contributions from your cap, you can bring those forward up to 5 years to make those contributions in future years. So looking at an example of how that might work. If we go back to the financial year 2021, the cap at that time was 25,000. So let's say that you put in 15,000 in that year. So in other words, 10,000 was unused that year. You could carry forward that 10,000 to the next year. And financial year 22, the cap was 27,500. You are allowed to bring forward that 10,000. So your cap in that year would actually be $37,500. Let's say you didn't make any contributions that year. It didn't work, or you were working for yourself and not making contributions. Carry that forward to the next year. Again, you've got a $27,500 cap for that year, but you can add the 37,000 and 37,500 bring forward from the previous year. So your cap in that year would be 65,000, and so on. And this can build up over 5 years. And you can see there in financial year 25 as an example, instead of the cap being $30,000 in this example, 107,500 could be put into superannuation. And you think about if you had sold an investment property or a business, a large asset, and you had to pay tax on that sale, making a contribution to super of $107,000 and claiming a tax deduction can be very powerful. So this is really helpful for primary carers or women that have spent time out of the workforce trying to catch up their super contributions. Really powerful for those that might sell an asset and try to reduce that tax with a superannuation contribution later in life. There's some little known other things, you've got to take advantage of every opportunity you can. So there's something called the government co-contribution, which is where if you earn under $62,000, the government would match 50% of your contribution up to $500. So you put in 1,000, they put in 500. So that's good. And the spouse tax offset's another one where if your partner was earning less than $40,000, you could put an after-tax contribution into their superannuation account up to $3,000 and claim a tax offset, which can give a benefit up to $540 as well. So, there's $1,000 that you wouldn't otherwise have had. This is also gaining a lot of traction, the downsizer contribution rules, and that is if you are over 55, lived in your home or owned the home for more than 10 years, and you sell that place, you can contribute each individual up to $300,000 to superannuation outside of the usual caps. So that is quite powerful. And if you think about what we talked about before of the bring forward non-concessional rules, that allowed you to put 360,000 into superannuation. If you add the 300,000 here, each individual could potentially put $660,000 into superannuation in one hit, which is quite a powerful way to get that into a tax concessional environment. So that's becoming more and more popular. Now, we touched on estate planning. I just want to go through that quickly as well. It's very important to know that superannuation doesn't automatically form an estate asset. So if you've got in your will where you want your assets to go, that doesn't mean that your superannuation is going to follow those instructions. You need to have what's called a binding death benefit nomination, which binds the trustee of the superannuation fund to pay that where you're telling them to pay it. Without that, you're leaving it up to the trustee of the superannuation fund to pay where they see fit. So if someone comes and makes a claim against it, they're going to have to consider that and potentially pay that money out. So a binding death benefit nomination is extremely important. Now, there's been a lot of talk about this following the budget, but Australia doesn't have death taxes, right? Well, by stealth, we do, um, because if your superannuation passes to an adult child, a non-dependent like an adult child, it actually attracts tax of up to 17%. So if you retire with $1 million, that could be $170,000 in tax if that was inherited by your adult children, as it often is. Now, there is something you can do to reduce that impact, and it's called a recontribution strategy. And we'll have a look at how that works in practice. So this is just a case study example. So say we've got Tom and Jane. They're 63, just retired. Jane has $720,000 and she's moved into the pension phase of superannuation. Now, her whole balance is made up of what her employer put in over the time as her superannuation guarantee. And then Tom, he was self-employed. He has no superannuation at all. Now, if they were to pass away now, Jane's kids would pay 17% tax on those remaining funds. So on that balance there, that would equate to $122,400 tax. So it's a fair whack. So what we can do is something called a recontribution strategy. Jane's retired, means she's met what you call a condition of release, which is where she can withdraw her superannuation. So today we withdraw the $720,000. Now, we can contribute up to $360,000 using those bring forward rules in one hit per person. So tomorrow we put $360,000 into superannuation for Tom and $360,000 into superannuation for Jane. Now that goes in as tax-free money, different to the employer money that's gone in. And that doesn't attract any tax when it passes to a non-dependent adult child. So in this case, we would have eliminated completely that $122,000 tax. And now if Tom and Jane pass away, the beneficiaries would pay zero tax. So it can be very powerful. Doesn't necessarily work for everyone. There's other strict rules around it, which we have to check, but certainly something worth considering. Okay, so we've talked a lot about the financial side of transitioning into retirement, and just as, if not more difficult, is the lifestyle and emotional transition into retirement. And you can't just play golf 365 days a year as much as, I or others might like to think that you can. We've got to go into retirement with a real purpose and intent on what we want to achieve from those retirement years. And when you think about health span today versus 20 years ago, 50 years ago, we could have 30 good years to really love life, be happy, be really purposeful, and have this whole new adventure. I think there's the stats around at the moment say over the last 50 to 100 years, humanity has added about 2 to 3 months of health span. So that is healthy living years, not necessarily lifespan, for every year. So every year we're making medical progress and health progress that's allowing an extra 2 to 3 months of health span. And there's a lot of talk at the moment, which we won't go into today, around artificial intelligence, technology, potentially even increasing that run rate. So this is a real new phase to plan for, and it's got to be given the appropriate attention, not just the financial side. And the most important portfolio in retirement, it's not your investment portfolio. It's the portfolio of activities, hobbies, and things that we're going to fill our life with in retirement. So what I'd like to do is just run another quick poll. This will be our last poll today. And this poll asks what your number one retirement aim is. So I'm going to put that up quickly on the screen there. What's your number one aim in retirement? Is it to have enough money? Is it to travel the world? Is it to maximize wealth? Is it maintaining relationships with friends and family or being happy? We'll just give everyone a couple of seconds to fill that in and I will share those results. Okay, I'll end that there. Now, there's no right or wrong answers here. Okay, this is individual. It's interesting. We've got a split across all of them. So I'll put those up on screen. You can see there a split across all of those responses, which is really fascinating. So thanks very much for completing that. I think one of the key things going into retirement is it's not our role in life to live up to the expectations of others. Our only role in life is to be who we want to be. And it's most likely that you spent the early part of your life trying to live up to the expectation of your parents. You spend the middle part of your life trying to live up to all of those around you and others' expectations. But that has to change in retirement, and this is our real opportunity to do so. 30 healthy years potentially ahead of us. There's a lot of life to live. Live it how you want to be and be happy. And that for me is the number one thing. And it's much easier said than done because when we leave the workplace, we actually lose a lot. We lose obviously the activity. Yeah, that takes up our time going to work, and we have to replace that activity with other things. So that's that portfolio conversation. We've got to really think about that and how we're going to fill our time. But more importantly, we lose the social connection. And often we've spent that part of our life and spending less time with our friends and our family and time with our work colleagues and getting that social connection that way. And it's not that easy just to pick that back up again. It takes real planning and thought how we're going to get back involved and build our social networks and connection, which we need as human beings. We're social beings. There's a real sense of accomplishment in the workplace. How are we going to replace that in retirement? Are we going to do not-for-profit work or other things to give us that sense that we're making a difference and accomplishing things? It does give us a real purpose and direction, and I think this is one of the key things. What is our purpose? What do we want our legacy to be? What is it that's going to make us happy, satisfied? And let's put that into place. The time and structure is huge. We have a daily routine when we're going to work. We know when we're going to wake up. We know when we're going to have breakfast and coffee and exercise and get to the workplace and go home from the workplace. In retirement, this is a completely new beginning and it's up to us. And this is one of the things that we see almost everyone struggle with when they first transition into retirement. That first 6 months or so, they lack that routine and structure, and it can affect them mentally. So one of the best things that you can do is a transition to retirement strategy where rather than completely retiring and going cold turkey on the workplace, you might spend a year or two or more transitioning and doing 3 days work or 2 days work and starting to fill those other days with other things and build routine into those other days. And that can be a way to ease into it and a more comfortable adjustment for you. And we lose a sense of status. In the workplace, we're helping others, we're mentoring people. How are we going to keep that up outside of employment? So these are things that really take time and energy into thinking about. And this is something that I particularly love helping retirees with and using the examples of the 3,000 families that we've helped through this journey to share those successes and failures. Now, this is my favourite slide today, and many of you might have read this book by Bronnie Ware, The Top 5 Regrets of the Dying. Bronnie was an Australian palliative care nurse, and she was lucky enough to spend those last moments with people before they passed away. And She spent that time interviewing them about their life, and she asked them what their top regrets were. So, going back to our poll question of what you really want to achieve, what's important to you about retirement, it's then fascinating to look at the people who were at the end of that journey and what their regrets were. Top five regrets. I wish I had the courage to live a life true to myself, not the life others expected of me. I wish I hadn't worked so hard. I wish I stayed in touch with my friends. I wish that I let myself be happier. And I wish that I had the courage to express my feelings. There's nothing there about money, about wealth. This is all about happiness. And like I said, it's not our role to live up to the expectations of others. Our role is to be who we want to be and what makes us happy. And this is really our opportunity at retirement to have a fresh start, new experiences, new beginnings, new purpose in life, and build that legacy for the remainder of our life. Okay, so when you're thinking about all of this, hopefully we've helped with some of those lessons from our journey helping retirees, and you've really got the option of do you try and do all that yourself and go it alone, or do you partner with someone? And Apt Wealth Partners, thanks very much to all of our existing clients that we've worked with. Sharing it with 3,000 families, you learn a lot over that time. You see the mistakes, you see what works, you see the successes, and we're able to pass that on and help new families make the most of that time. And we now manage more than $3 billion of clients' funds and help them through this journey. So that is Apt Wealth Partners. And the way that we work with our retirees, and of course, it's very important getting the investments right, getting superannuation right, maximizing your income, and making sure that people really understand that, because the understanding breeds peace of mind. But it's doing all of those things, surviving the market downturns so that you can live the lifestyle that you desire and really help you to be able to articulate what that lifestyle, emotional transition looks like and get on with doing it. So that's it for today. Thanks very much for attending. I've got some time for some questions, so I'm just going to pop up the Q&A box. Thanks for your questions as we've been going along. Let's have a look here. Super contributions. Are super contributions only available to salary income or property rental income or other earnings? Thanks for that great question. So when we talked about concessional contributions, that can be what your employer's putting in for you, and that's one type of concessional contribution. The other is where you just make a contribution and claim a tax deduction. So that could be in your example where your income actually comes from wealth, from rental properties or share dividends. You can make a super contribution providing you meet all the age limits and so forth and claim a deduction against those earnings, most definitely. So it's still attractive. We've got some questions just asking about some of the slides. We'll send out a recording of today's event, and you can view all of that again, no problems. Are withdrawals from superannuation in the retirement phase affected by the capital gains tax changes? That's a great question. Thank you for that question. Now, this is one of the things that's going to make superannuation even more attractive, and that is the proposed capital gains tax changes at the moment don't have any impact whatsoever on superannuation. They'll retain all of their existing concessions. So, yeah, people are going to be using superannuation more than they ever have before because of that. And I've got another related question here about the budget changes. Does a trust still make sense? Now, that's really beyond the scope of today's presentation, and we're yet to see what the final legislation will look like. But I think at this stage, they can still make sense. They have a whole range of other benefits other than just purely tax benefits, estate planning, and so forth. But we're going to need to see what the legislation looks like before we make that decision. what I can definitely say is related to that previous question. Superannuation is more attractive than ever uh, with those changes going through. Another question, is there an age limit for reinvesting in superannuation like the Tom and Jane example? Yes, there is. So those non-concessional contributions can apply up to age 75. That's the cutoff. Concessional contributions is a bit different. Depends on how long you're working and so forth. Comes with a different set of rules. But it'd be age 75 for that recontribution strategy that we discussed. One or two more questions here. Do I need to hold a self-managed super fund to hold my own investments? Great question. No, you don't. A self-managed super fund can be very effective and does let you hold a whole range of assets, and I suspect will be more and more popular going forward given the proposed changes to trusts and capital gains tax outside of superannuation. But there's plenty of other superannuation funds that will allow you to hold your own investments rather than being in that pooled structure. Could I eliminate the beneficiary tax as an individual with over $500,000 in my superannuation? That's a good question because you remember in the example, we talked about contributing $360,000. So the answer is not in one hit, but you may be able to do it over a period of time. You might be able to do 360,000 today, wait 2 years. When that contribution limit resets, perhaps you might be able to do it again and eliminate the remaining tax. Last question, do superannuation contributions have to be made to my fund from me, or can it be from a company or trust on my behalf? Yes, it could be from a company or like lots of people who run their own companies make contributions through their company, and that's their way of getting the money into superannuation. The deduction will ultimately flow back either to the employer if it's an employer contribution or to the individual if it's an individual. All right, so that's all we've got time for today. Thanks very much for attending. We'll send out a recording after today's event. Feel free to share that on. Check our YouTube page for other webinars that we've run previously and keep an eye out for future webinars. Thanks very much again. Hope you enjoy your day. Until next time.